We have got a panel session on the way next, so just bear with us while we update the stage here and sort our chairs out for our panelists. And we will be welcoming up to the stage some fantastic speakers, and we're going to be discussing the growth of multi-asset trading in 2021. And of course, diversification and having multi-assets, all the big rage and lots to discuss on that. So we hope it's going to be a lively one and an enjoyable one. So good morning, and let's get this panel discussion underway. The topic is growth of multi-asset trading in 2021. And I'd like to welcome with me, we've got Ali Rupani, David Dubrulle, and Abdulla Harmoozi. If I could just go down the line and let you all introduce yourselves and tell us what it is exactly that you do. So Ali, we'll start with you, please.
Sure. Morning, all. My name's Ali Rupani. I'm the Chief Sales Officer for Squared Financial. I have an investment banking background. I covered the Middle East for about 10 years for Goldman Sachs. So new experience for me, but very excited to be part of it.
David?
Thank you for having me. My name is David Dubrulle. I'm the CEO of Engageme Trade, Engageme Financial Brokerage in Kuwait. Been in the region for 17 years now. Also have a diverse financial background from investment banking, capital markets, and online trading.
Abdulla?
My name is Abdulla Harmoozi. I work in DGCX, Dubai Gold and Commodities Exchange, one of the largest government-owned derivatives exchange in the region. Currently, I'm more into Sharia, so I'm into Sharia product development as well as giving lectures to university students and these kind of things. Thank you.
So education is going to be a big topic here as well, I can see. So first off, post-pandemic, a kind of new shape is evolving in online trading. Brokers are adding different asset classes like CFDs, stocks, indices, crypto as offerings to traders. How do you see this growing need for multiple assets, and how are brokers kind of rising up to meet those needs? Ali, can I start with you?
Okay. Obviously, I think from our perspective, we've seen the technological advances, we've seen the sort of adoption of mobile technology across generations as something, we're very excited about. I think it's very interesting for both brokers and investors, where all of a sudden you have multi-generations who are very excited and able to use mobile technology, are confident and able to do their banking, shopping, whatever it may be. So all of a sudden you now have the opportunity to invest and diversify portfolios and incomes by trading. So from our perspective, we're spending a lot of time on building our own capabilities and platforms. The process of democratization of knowledge is allowing a new generation of investors to become financially literate and involved because they can do everything on their mobile phone. So from our perspective, we see the growth and the explosion that we've seen in the past few years, where 5 years ago, multi-asset broker would have 200-300 odd instruments. You're now looking at somewhere between 5,000 and 8,000 instruments, and probably in the next 3 years, that's going to be sort of in the tens of thousands. So from our perspective, we think it's a great opportunity for both brokers and investors to sort of embrace that and make the most of it. So it's a big opportunity.
David, if I can come to you, same question.
No, absolutely. Nobody can deny the advancements of technology and the access to markets for the retail and small corporates alike. Of course, there is always a balance to be maintained with respect to offering way too many products and balancing that lag of education with clients and giving them products they can easily trade and understand. But it's true that the mobile-centric approach allows them to really simplify their access and invest in multi-assets, even bundled assets, in a very simple way, so that they have time to actually catch up on the lag on the education, because each market has its own challenges, its own rules, its own custody issues, and the synthetic approach also removes that, but enables the younger generation to force them to learn a lot about the infrastructure that behind all the financial markets.
And Abdulla?
Actually, there's two perspectives to the growth of multi-asset trading. From the trader's perspective, obviously, in today's volatile world economy, I think many traders have adopted new strategies when it comes to online trading. They are actually looking into different asset classes for the sake of diversification, which is a very important topic when it comes to multi-asset trading. And then from the broker's perspective, I think to remain competitive in the market, you need to add, those kind of products or different new asset classes. From what I have seen recently, I mean, during the pandemic or after the pandemic, there's a lot of new trading avenues have started online, and the number of those trading avenues have increased significantly. And I mean, I think, for those who are only focusing on FX, I don't think they will remain competitive here in the market. That's for sure.
And seeing as you kind of brought it up, how important is it to have a diversified portfolio these days, as opposed to just putting it in one particular asset?
Yeah. Basically, let me just give you a live example of DGCX, where I work in. So basically, during the pandemic, I remember we have traded around 2 tons of physical gold in DGCX. And most of them were actually from the regional countries like Saudi, Kuwait, Qatar as well. And, we understood, we knew that, during those hard times, people that they were actually focusing on certain asset class, they actually went and tried out different asset classes, like gold being a very important one. And it's not only when it comes to commodities with gold as well. They have adopted a more complex trading strategies like hedging. So in DGCX, we do offer future contracts on different asset classes, and we've seen a growth number of volume in DGCX.
David, same to you?
Yeah, I mean, the hedging I think is essential, and the diversification, access to the market diversification is very, very important. And that obviously is going to take some time, because with diversification into multiple asset classes, you need to be able to do this correctly. You need to proportion the sizes. You need to be able to understand the rationale of why something is strong and why something is weak, or what asset is strengthening or weakening. However, and that's the problem, is like you can actually, when you have too many products, you think you're diversified, but you don't yet have the knowledge of what a true diversification is in terms of your asset allocation. And then obviously with a lot of different products, you need to see how much it costs you to carry those products for a certain amount of time in order to complete your strategy. And when you're looking at asset diversification, you're not looking at short-term views. You're looking at more swing views, 3 months, 6 months, 9 months cycles, which allows you to complete your alpha return with respect to the market and get the return you want with the risk that you've actually positioned yourself with.
And Ali?
I think I have my view is slightly different. I mean, I think what we've seen of late is, we've seen a lot of the traditional correlations break down, right? So, for example, you're used to having markets where we have equity prices high, you'll have bond yields or bond prices a lot lower, and vice versa. But I think what we've seen over the pandemic period is the injection of liquidity from central banks globally has created massive asset bubbles across different asset classes, which also in turn has made it a lot more difficult to for the investor to acknowledge what now looks like a balanced portfolio. And I think what we're now seeing is that as that leverage potentially starts to come out of the market, as central banks look to taper, right, I think we may have a correction in asset classes that we may not anticipate should be the asset classes that are correcting. So I think in that environment where traditional relationships and correlations start to break down, it becomes very hard to say, okay, what does a balanced portfolio look like, right? So, from our perspective at Squared, I mean, the view there is that, if you are going to try and build a balanced portfolio, right, you should average into one, because there will be volatility and volatility shocks that allow you to either average into a better position, or if you've got the wrong view on the market at that point, cut the risk and you haven't lost what you're willing to deploy as capital. So, I think we're all saying the same thing, but I think there is an element that your traditional correlations and what is a portfolio is not what it used to be 3, 5, even 7 years ago. And I think Bitcoin and the rise of crypto is also playing a major impact on that. And as we've just discussed slightly earlier, the fact that you are able to trade crypto, which is a new asset class for everyone.
Ladies and gentlemen, have you heard about Outre Gold Rush? Visit booth number 6 and enter one of the biggest gold giveaways in brokers history. 4 kg of pure gold awaits you. Make sure you visit the stand today. Thank you.
Abdulla, is that your gold? I was about to say the same thing. Nice move.
Before we were so rudely interrupted.
Right. So, I was just saying, obviously, from a crypto perspective, that now is increasingly becoming part of an asset allocation that people are looking at, but we don't know enough about it yet because it's still a fairly new technology. So, how do you throw that into the mix and sort of add that into what a portfolio should look like?
And seeing as you brought it up, crypto, I think, has been, because it's so fascinating as an asset, and there's so many different types in the crypto realm. Have you seen more people come into trading realms because of crypto, because it's kind of piqued their interest a little bit, and they've sort of gone, oh, this seems interesting, let's give it a whirl?
From our perspective, we definitely are seeing an increase in interest in crypto. I think the issue that the industry is having at this point is being able to offer a crypto product where the costs of whether it be the bid offer spread or the actual fees in and out of a transaction are low enough to allow investors to make money on the back of that. If you're paying 6, 7, 8% just to get into and out of a trade, right, that means your break even is significantly higher. So obviously there's a big rush into crypto. A lot of social media, a lot of people think that they can become and do very well in a very short period of time, which is sort of adding to that bubble. But the accessibility yet, I think, for people who want to trade day in, day out, is still something that I think in the coming months and years will be a lot more easy for them to access. But I think at the moment, the costs are high for them to actually trade it, say, for example, compared to Euro-dollar or dollar-yen or, sort of the traditional instruments. But I think it definitely will come.
David, good entry point or not?
Yes, I mean, of course, yes, the cost of crypto were a bit elevated, but again, if you're looking at that from a CFD perspective or just it's challenging. But crypto has brought a multitude of things to the market. One being the speed of capital formation. Two being the simplicity of creating an asset or even synthesizing another asset and being able to make a market, automated market making for those products. The third thing, which is very interesting to me and which I think will transform a lot of our industry, is that the tools that today the traders are using and they have access to in terms of correlations, arbitrage strategies, execution, AI bots, et cetera, those tools, although they're very young and immature, and although they're applied to a market which is crypto, which is highly correlated because everything moves kind of together, as you know, in the market so far, we will soon reach a time where we'll have a differential and correlation for the crypto itself. But those tools, what I was talking about, and that attitude to trading has created a fantastic platform for to the retail market, which granular analysis and able to act fast into the markets, which has never been seen before. So, having said that, if you're a crypto trader and you have a lot of products, if you just go buy BTC physical, you have no cost of carry unless you actually have it at a custody. And today, BTC, if you're a big trader, is not going to cost you more than 0.5%. 0.5% on the volatility of a product, which is 10 times FX, seems a little bit interesting. Volatility is opportunity at the end of the day, as long as you know how to manage the risk.
Abdulla?
Yeah, I think the social media has played a big role in promoting crypto and other digital assets. But I think, one of the reasons behind becoming really popular recently, and during the pandemic, I remember, it's basically easy money or making money or getting rich very fast. We've seen a lot of influencers, a lot of financial gurus, talking about their experience when it comes to crypto and how they made money and how they got rich in such a short time. But I think it's, it's a bubble. They've created a bubble. It's really hyped, and one day this bubble will burst, for sure, 100%. And, like what my colleague has mentioned as well, in terms of correlation, it's very hard for you to predict what's going to happen with the crypto market in the future. Like let's say if you have your normal Bitcoin or Ethereum, you wouldn't know what's going to happen. How you can relate, the performance of the digital asset with the real economy. This is a big challenge as well, where people they do not understand. So the way I see it, basically, it's based on speculation. So you just try your luck. You put your money there, and then you just wait. This is the way I see it, to be honest.
I respect that opinion, but I respectfully disagree, because today you're trying to compare a crypto market and the way of analyzing, the way of fundamental quantitative analysis for something, and try to do that with a framework of traditional assets, which is you lose the battle before you even begin, because they're apples and pears. Yes, there is a bubble. ICO was a bubble. Today we're seeing the second, and it popped. We're seeing a second iteration of it, and of course there's a lot of influencer, a lot of many coins being created and social media pushing. But the point is, every time there's a new milestone that is reached with the blockchain technology and the crypto market, which solidifies and then transcends and infiltrates, and you're seeing much more infiltration and cross applications now in terms of a centralized and a decentralized world. So, I mean, it's the problem is you try to put a value, when people try to put a value on Bitcoin and Ethereum, they try to put it with a framework that they've been taught for many, many years. And it no longer works like that, because the fundamentals are what drives the value, what drives the usage. It is completely, it's very foreign, it's a very foreign language to even the most professional, seasoned professionals.
Can I just jump in? I think my view is in between both of you, right? And by that I mean that I think I can see the use case for crypto, right? So the likes of Ethereum in terms of, the scalability of the use of blockchain technology. I think the view that something like Bitcoin will become and supersede fiat currencies, I think was, with what the Central Bank of China did last week, right? I mean, it was only a matter of time before one of the big central banks came out and made a move like that, where all of a sudden cryptocurrencies, right, sort of become persona non grata within the country, right? So it would have been the Fed or the ECB or, the PBOC, right? So, I think cryptocurrency, sure, I don't see it becoming, a major influence from a global currency perspective, but actual adoption of blockchain and crypto technology in other uses, I can definitely see a massive use case for. So I think maybe I'm in between both of you.
No, I mean, I think it's important to be in between, because it's a very large, granular subject that can go on for days, of course. But I mean, the technology is, for me, personally, I find it fascinating, because I can see it being applied in many areas and transforming. But a simple smart contract for me has revolutionized what finance could be. Has revolutionized what the average person like me, or any trader that can actually have a certain amount in a stable coin and be able to get a 3 or 4% return on that investment instead of sticking into a bank. And on top of that, what we're seeing is that larger and larger players, family offices and banks and large portfolios and corporates, they are no longer selling their crypto. They're keeping a large percentage of their funds in crypto, and they're borrowing against it. So you no longer have the cycle of actually having to buy and sell and realize. So the fact that they're holding it long term and borrowing against it, because it's actually cheaper to borrow 2 or 3% Bitcoin and then invest into another asset class, which is giving you a higher yield, is very transformative. And that's all thanks to the smart contract framework and the clarity. And you remove a lot of, just to transfer, buying institutional shares of Google is going to cost you X amount of dollars just to transfer custody from one to another. And that cost makes it extremely prohibitive for the retail guy to come in and trade fractional shares in a safe way and benefit from the market.
And I'll just say, a lot of those crypto influencers and millionaires have moved to Dubai and are buying 7-figure penthouses and all the rest of it. They're sinking millions into the local economy. We'll take it. It's fine. Not a problem. In capital markets, do you think leverage has played a vital role in increasing trading volumes in other asset classes beyond Forex, Ali?
I mean, obviously, I think, the very simple answer there is yes. I think, where you're in an environment where, rates are at all-time lows, where there's massive amounts of liquidity having been injected into the real economies, right? You do need that money to be put to work somewhere, right? So, whether that be in crypto and the boom in crypto because you can get a return. And obviously, we've seen major asset class bubbles across the board because the money actually does need to be put to work. I think what's going to be interesting is when we start to see central banks taper, what happens at that point in terms of where does the bubble burst, in which asset class, and I think that's going to sort of then determine, given the amount of leverage that's already in the market, right, how that correction sort of, asserts itself. And, obviously I think it's also quite interesting to see that, we have seen sort of, regulators, look to crack down on the amount of leverage that's been offered to investors and consumers, because it's simply adding to that that inflationary bubble.
David?
I mean, when I talk about leverage, I go back to the old saying: there's good debt and there's bad debt, right? So, and then there's good use of leverage and bad use of leverage, right? So you have to look at it from what is the leverage created for. The problem is from the retail perspective, a lot of leverage, unfortunately, sometimes is the rope people hang themselves with. But leverage used correctly is extremely important, because a simple margin or ability to be able to borrow and be able to trade stocks or ETFs, etc. The smaller guy, the small retail guy, he has to go out and buy a stock of $3,000 on Amazon. Right, so he's got $5,000 or $6,000. He cannot diversify properly. So the good use of leverage allows you to have, say, 1 to 10, 1 to 5 on proper stocks, which with proper services, proper liquidity, and proper execution, and proper pricing, price discovery, of course. But at the same time, that same person has benefited from that diversification, because now he can actually, if he's disciplined enough, he can actually trade some volatile markets, but at the same time hold a longer term, themed portfolio, because thematic, I feel, is severely underrepresented. Thematic is something that is very foreign to retail investors, but now there's a lot of the big push to be able to create a very one-stop thematic approach where people can actually click and just get exposure to a theme, like a COVID theme or like a social media theme. And the leverage there is extremely important, because without that, you'd be just too skewed, and you would not have enough time to react if the volatility went severely against you.
And Abdulla?
Yeah, I think as what David has mentioned as well, there is the good and the bad side of leverage. So the good side is basically from the perspective of the investor or the trader, they can actually take a greater exposure on the market with lesser capital requirement. And therefore they can actually gain more profit. At the same time as well, leverage could be a bit dangerous. You could increase the risk of losing your shirt overnight. That's the expression they say. I would say, from my opinion, a good trade is the one balanced between risk and market volatility. This is the way I see it.
And speaking of volatility, has the recent volatility in global indices and stocks having an impact on the multi-asset trading? And I think we've seen volatility across so many different assets and markets at the moment. How is it affecting everything in the multi-asset trading realms? David, I'll start with you on this.
I mean, for me, volatility is a great thing. It's a great thing for brokers, great thing for clients. Again, it's volatility is the conduit for you to be able to make profit. If there's no volatility, there's no returns. So bearing that in mind, when you start from that mindset, then you start to build around the volatility. And today, one of the simple things that we teach our traders at JM Trade is don't look at the pair by the size or the liquidity. Look at the pair and classify it by volatility and see the opportunity that you can capture based on that pair. So we try to apply that educational narrative across the board. It's a little bit difficult to comprehend because people still see volatility as risk instead of opportunity. That's just a lack of exposure and tools and education, of course, but that will catch up. But I think volatility is great. However, the volatility is, again, is very dependent on the market cycle that we are in. If you're in a highly volatile market, and today we have, we've printed 40% of the US dollar the total supply was printed in the last 2 years, and everybody thinks this is okay, which I don't, by the way. So having said that, when the volatility, you have high volatility pockets, and you have these shocks, those are amplified tremendously, and that's what's very dangerous. But and people have to be wary about that, and a little bit of protection, like physical metals, for example, exposure is very important. I'm helping him out here.
Yeah, and look, I think to add to that, we also alluded to this slightly earlier, where historical correlations have broken down or are less prevalent than they were historically, and where you had, say, volatility acting in accordance, say, during the peak of the pandemic, right, where equity markets were selling off globally in one sort of, in unison, where, 2-3 weeks ago we had the Evergrande situation in China, and the view there was that we'd have a contagion and spillover effect in the rest of the globe, and that didn't happen. But, the market was pricing and bracing itself for a knock-on effect, right? And again, where I'm saying the correlations may have broken down, right? I think the market assumed that we'd have a knock-on effect of contagion, but then didn't look at the actual fact that the international bank's exposure to Evergrande wasn't that huge, right? It was a China story, right? But the implication was, well, it's going to impact the whole world, and we're waiting for a sell-off, right? So I think, that's where you sort of, as an investor, educational, or as a broker, where you can speak to your clients and sort of have that informed view that actually it's not necessarily going to be as you think it may be, and this is why.
And Abdulla, what's your feeling on volatility?
Yeah, basically in DGCX we love volatility, because if the market is volatile, we actually, we get like good volumes. And from the trader's perspective, it really depends. With volatility, you can either make money or you can lose money. So there's two sides of basically the story itself. Volatility as well, and indices and stocks has encouraged traders and investors to look into different asset classes, just for the sake as well to secure their capital. So the key word here is a diversification. This is what I've seen. I've been working a lot with hedge funds, with a lot of banks here in the region, and most of their strategies revolve around that as well. There are some family offices. I remember during the pandemic when our Sharia gold contract, which is our basically physical gold contract, it was trading really high. And the main reason for that was because of the volatile market. And people, they just wanted to secure their capital, to allocate a bit of their funds into gold. And this is the key, when it comes to volatility. Volatility is nice, but obviously you need to be aware that, with volatility, you can actually, take a huge drawback.
It's playing the risks, isn't it? And obviously, compared to how we used to do things back in the day, do you see the access to multi-asset trading is far more available and easily accessible to traders these days through the rise of technology and apps and online platforms and things like that? Is it far more easy to get into these realms these days? Ali?
Absolutely, right. I think, the likes of Robinhood, they've really sort of changed the game for a lot of us in this room today, right? The accessibility of technology, the accessibility of knowledge, the accessibility of information, right? The actual ability for, say, for example, the retail traders to come together and overthrow some of the big hedge fund shorts that we saw in Q2 and Q3 this year, right? 5 years ago, that would have been almost unthinkable, right? But now technology has allowed the likes of all of us here in the room, right, to access and to be able to trade. So, and I think that only gets stronger and stronger, right? It only makes, companies like Squared and the other companies in this room want to provide more product for their clients, better technology, to engage with them, to allow them to do the same. So absolutely, 100%.
And David, where do you see it all going as well?
Yeah, technology is key. Even I think most brokers today, I think are considering themselves more as fintech companies than brokers, to be honest. So The access is very, very important. Yes, the Robin Hood effect is clearly there, but at the same time, there's a lot of surrounding elements that you need to account for. We've seen Robin Hood, people come in, but retail clients don't have the slightest idea of what price discovery is. So when you have a very connected environment with multiple assets, multiple countries, multiple exchanges, everything moves a lot faster. Price discovery happens a lot faster, which also helps manage the volatility risk for institutions, of course. But technology-wise, I'm a little bit worried sometimes because, and I see this also for the crypto side and the trading, is that although we are seeing a little bit of a gamification strategy, which for me is great to attract, but there has to be a follow-on in terms of a push from industry leaders to make sure that gamification is followed by proper cementing education and notional financial literacy, so that you don't fall victim of thinking it's just a game and you're gambling with your future. When you're younger, it's true, you can take a lot of risk. You can actually take the most risk. It's only when you get older you have to start pulling back on the risk. That's the basic financial planning. But, and this is the only concern I have, but in terms of technology, it's, even us, we just launched our mobile app with 2,000 products and it's seamless, right? But we work very hard to build, even Arabic-centric education with connection to options, futures, correlations, deltas, trading strategies, the knowledge, so that people don't fall into that trap of volatility plus easy access creates, it's just a game, and then when it's all over, they're left with a bad taste in their mouth, and that's not good for anyone. So I just want to make sure that everybody does that.
Abdulla?
Yeah, I think basically in terms of the access to the multi-asset trading has increased significantly. I mean, for the past 1-2 years. I mean, as I've mentioned before as well, for a broker to remain competitive in today's market, they need to give this access. So today we've seen a lot of trading avenues, online platforms, as well as exchanges. They are basically offering different type of assets in a single platform. I think it will keep growing. I would like also to give an example. As an exchange, we started as a commodities exchange, but now actually we're looking into crypto as well. So in our pipeline, we're trying to enhance our Sharia offerings, at the same time get into the digital asset market. So, that's the thing, the most important thing is for brokers, companies, or online trading avenues and platforms to start offering different type of assets, which is, it's the key, to be honest, to remain competitive, and this is today's market.
Fantastic.
May I just add one point? So I just forgot to say it. For the future of tech, I think that we should be able to benefit from a hybrid of a decentralized and a centralized model. The technology, even on the blockchain side, should allow companies to do that bridge. A typical example was Robinhood. Robinhood's fantastic, but when we had that incident, they just locked access to everybody's account, which really created a huge drive toward decentralized exchanges and decentralized tokenized assets. That part is a bit annoying, and it needs to be properly watched, because if you do a certain action and then you push everybody towards the DEXs, decentralized environments, you might also be putting them at risk, because there's a lack of monitoring. Everything's automated, and we need to have a blended approach on that. And they need to find the gap. Regulation and decentralized needs to find a way for these institutions and the decentralized technologies to collaborate seamlessly.
And I'll just add one more point to that, and I completely agree with David there. When everyone is trying to exit a trade, the door becomes very, very small, right? So, us in this room here, we have an obligation to our clients, our customers, to ensure that, we provide them with the liquidity at that point, right? It's...
I so wish we had more time because there are so many questions that I have to ask and so many follow-ons, but we have unfortunately run out of time. But fantastic to have you here, gentlemen. Thank you so much for this panel discussion. It's been amazingly interesting, and I'm sure if you have any questions for our lovely panelists, you can find them at our booth. Thank you so much. It's been a brilliant insight. Thank you.
Thank you. Thank you very much.